Once we break the first level of demand or supply or structure, we look for an entry. We can enter here if we wanted to. We can enter here, enter here, and then price probably start getting a little overrun. But you can take both of these trades and say, I'm going to target these lows because I understand internal and external range liquidity. In today's video, we'll be breaking down liquidity concepts, how to use them, and most importantly, how you're going to make money from them in the financial market. But the most asked question is, where's liquidity in the market? How do I use it? How do I know if it's valid liquidity? In this video, by the end of this video, I guarantee that you will understand all of these things to a perfection. If you're new to the channel, welcome to the team. My name is Divine. I am a six-figure funded trader on my way to make my first six figures profit in the markets. And today we'll be going over something that was very, very difficult for me, and I got through it. Liquidity is very tough, but it is the key to the markets. And if you know liquidity, you know the markets. If you can trade liquidity, understand it, you know where the market is headed, you know why it's going there, and you can validate every trade that you take. So let's get straight into it. Alrighty then. So as we can see on the charts, man, let's get straight into it. So we have it's a lot more types of liquidity, but these are the main ones that I have for you today. And all of these I will break down in more detail, but let's go over them straight. So when we talk about retail, we talk about people who trade trend lines, trade support resistance, they trade these retail concepts that are very common. There's no knock to them. There are people who make millions and millions of dollars trading these concepts, but we utilize these as liquidity. For example, we have double tops here. When you see double tops, double bottoms in the market, that can signal some sort of, hey, there are orders, meaning there was somebody who got in the market here, somebody who got in the market here, and there are orders in the market to move that price probably wants to go to. Also, on the other side of that, we have triple tops, triple bottoms, and we have relative equal highs or relative equal lows. Triple tops is or triple bottoms, very self-explanatory. It's 1, 2, 3. We have three levels of supply or three levels of orders that were here that got push the market down, and we expect the market to go up and take those levels potentially in the future, near future, or later, right? And then the reason we call this relative equal highs is because and this is not really equal, like perfectly. Like these ones are a little bit more perfect, but they're all relative at the end of the day. You can have a high or something like this, sort of, where it's like relative equal lows, and price is going to go track and grab that liquidity. If you don't know what liquidity and the importance of it is, liquidity in the market is orders. So when the markets move up and down, the market needs liquidity. It needs orders, it needs buyers, it needs sellers to move price. So it's not necessarily stop loss hunting and all this stuff that people say. Yes, we believe in those things and we understand sweeps and manipulation, but when we talk about liquidity, it's simply where the market needs to go to get more orders. So when you see double top, it's not that it's a double top, it's the fact that there's two areas where sellers got in the market that are sitting there. It's a bunch of sellers and buyers waiting at this level, so price will go back to that level, sweep that level, and then that's how we make liquidity to move the market in the next direction. Then we have supply and demand levels. So I trade supply and demand mixed with liquidity concepts, a little bit of ICT. This supply and demand you can be liquidated trading off a supply and demand zone. For example, you have three supply and demand zones. You have your extreme, decisional, and then you have that high point, right? You never want to trade in the premium of this level anyway, high and low. So when you come back down here, if you try to take a trade from here, more than likely, price already made a market shift, it's going to break and go fill all the way to that extreme or test a decisional level or something and continue higher. So all these people who thought they were going to buy from here, again, those are orders that the market gets. So you get a bunch of buyers in, so now they can fill sell orders, and then a bunch of sellers get in the market, and then they can fill their buy orders to push price up. And then the opposite is the same for this side, where you get price pushing down. You think these are supply levels, but they're actually not. And then price comes, takes out those weak supply zones, and then we go to that extreme one, and then we take it out. And this is another example of just like a buildup of consolidation. We sweep the lows into a demand zone to the left, use these sellers as supply, or people who think price is just going to break out to the low side, use them as liquidity, and then we move market to the upside. Same thing here. Consolidation, sweep the highs, and then we push down, take the lows, and we liquidity. When you see these big moves, it's liquidity in action. Why? Because there are a bunch of orders that were gathered up before, and then once we took price where we needed to go to propel price faster, stronger in a shorter amount of time because the amount of orders and liquidity in the market. When you see the market moving slow and low, it's not a lot of liquidity, not a lot of orders being built into the market, stacked into the market. So this is how supply and demand traders like myself can be liquidated, trading supply and demand zones. Asia, you always see a little box. And on the charts today, I'm gonna give you guys examples for all of this, so stick with me here. Just stick with me. I know you want to get to the charts. We're gonna break it all down, I promise. I just need to show you these outlines and things because it makes a lot more sense and it's very easy to see like this. So just bear with me because I'm telling you, by the end of this video, when you see it all, it's all gonna blend. You're gonna be able to see it easily. All right. So Asia session right here, we usually take the highs and then say it was a supply level to the left here. We tap into that supply, we get in. We now have a target or liquidity to target where price would like to go because Asia lows are right there, right? This happens nonstop, all right? And then the same thing here. Asia session, we take the lows again and we take the highs, we tap into a supply and then we push to the low side. We take the lows, we tap into a demand side, we take the highs. Very simple. I know it sounds complex, but it's going to be very simple. Then we got weak highs and weak lows, which is my favorite because it kills a lot of people in these markets. And this is something if you learn, you will be top tier. Watch. So essentially, a high's job is to take lows, and a low's job is to take highs. This low was to take a high to the left. It did that. This low was to take out this high. It didn't do that. So when that doesn't do that, that point in the market is nothing. It's pure liquidity. This level here, because it made a low, higher highs, higher lows, its job was to what? Take out the next high. Well, no, we're still in that downtrend because we couldn't do that. So if we can't take out this high, this wasn't a level that was strong enough. It didn't gather enough orders, enough liquidity in the market. So it becomes liquidity. The sellers step in, they take out that level, and then we get to a level where it's a bunch of orders, and then we end up taking out everything, right? So we use these levels inside to not trade off of, to understand that we can still be patient and wait for our setup, and to target for future targets when we do get in our trade. Same thing here. We got lower low, lower high, lower low, lower high. We couldn't make a lower low, so that gets swept out. We tap into that lower high supply, and then we make a lower low. Very simple. I'll explain it on the charts. And it's our internal and external range liquidity. And essentially what this is how you catch monster moves. If you're a swing trader, this is probably the best concept for you, literally. Because as a swing trader, you want to catch big moves, but you want to know where the price is going, and you don't want to have to worry about it. Well, what we say is once my price is trending and that first level of demand or supply breaks, we are now filling in internal range liquidity, meaning this low, potentially this low, when it's not going to hold, right? For example, right here is the same thing. High, low, we broke in, came to the extreme. That is what happens. It uses this internal levels, these old lows and old highs right here. It uses those levels as liquidity to propel price in the direction it want, to get people in the market, get enough liquidity, and then move it in the direction that it would like to move in, right? So this right here, we take the rule is once that first level breaks, this happens on every time frame, which I'm going to show you on every single time frame today, that once the first level breaks, it's ball game, right? You can look for sales, you could wait, get that third leg right here, and then you could catch that big move to the downside. It doesn't always make a new low or a new high, but if demand was in control, you could expect price to turn all the way around. If supply was in control, you could expect price to turn all the way around. That's internal, external range liquidity, which I will show you guys. And I know that was a lot of information, but what I'm going to do now is give you examples for each of them. It's going to be very, very simple, but very, very in-depth because I want you guys to know this. Asia highs and Asia lows will be your favorite concept. And then weak highs and weak lows, I'll show you right now. So let's get right into that, get some real life examples and break everything down. All right, guys, so let's make this really quick. I don't want to keep you out too long, so let's get straight into it. Double tops, double bottoms, triple tops, triple bottoms. Let's find a couple of examples. For example, boom, right here. So we have a relative level of equal highs right here, right? 1, 2. Simple, simple, simple. I'm going to map that out and say, okay, cool. Well, we know that potentially, let's say we were looking for buys down here. We would say, all right, at this point, this is perfect, guys. I hope you guys can see this because I could take every single thing that I just taught you and put it in one map. So let's say this is our high up here, and let's say this is our low down here. All we need to see is we took out the first level of supply. So let's talk about our internal, external range liquidity first, actually, with our double top and double bottom. Well, our internal range liquidity, as you can see, we said once that first level goes, if you go back in the video, if you don't remember, just go back in the video. Once that first level goes, then we expect all these other levels of supply or whatever you want to call them to actually fail and not actually hold, right? Like so. So if these are levels that we don't expect to hold or anything like that, then we got to understand that once that first level goes, we can now target this high. We can now target all of these levels in here because one, we could target this, we could target these Asia highs, we could target this high. This is a weak high now. We can also target this high, and we have relatively equal highs right here that we can target for future liquidity. So example, if we got in here, if we got in somewhere around here, easy, simple target. Price doesn't just go there for any reason. It went there for a specific reason to take all this liquidity. And even more so, something we didn't really cover, but something I don't pay attention to, but is liquidity, is trend line liquidity as well. As you can see, if you took buys around these areas down here, somewhere down here, you can say, hey, listen, my first target is going to be this high right here aligned with this liquidity right here. Very, very simple. Very, very simple trade. And you see price go straight to that trade. Very easy, very smoothly, right? So that is how we use internal, external range liquidity, which I'll show you on the daily time frame too, because it's a beautiful site on the daily. Now, if we look at this price action here with Asia, so the box on my chart is Asia session, right? I'll darken it a little bit more if we can. Let's see if we can. I don't know. But this is our Asia session right here. And essentially, we have a demand zone that swept liquidity and we made a move up. Why did it sweep liquidity was you can see here, it actually took Asia lows, right? So this was weak action. This is actually an example of price taking the lows of Asia and then taking the highs of Asia. If you got in somewhere down here, easy trade to take out the Asia highs, but we want to do that here. So all we want to do is align price and say, we have a demand zone here to the left. These Asia highs are still intact. We respect this level of fake supply, right? This job, this supply was supposed to what? Make a new low, which it did. So now we have another level of supply, but our true low is down here. So if we actually come over here and understand, we say, hey, listen, we took Asia lows, we have Asia highs intact. We can target potentially Asia highs. So if we took a buy here, we put our stops here, whatever it is, we can say, hey, I want to target Asia highs easy. That's one reason why where we spot the liquidity in the market, because that's all you want to do when you're looking for your trade. Where is my liquidity at? Okay, cool. Well, this point took liquidity. Well, where's my liquidity rested? We have liquidity up here, and we also have liquidity rested here because this is a weak high. This is a weak high. Why are those weak highs that we just talked about? A high's job is to do what? Take the low. So if we are in between this low right here and this high, these points did not do their job of taking out that low, hence they become weak. So when we do look for that buy, we now know we can target that high because one, Asia highs is still available to take. Also, two, this is a level of a strong protected low because it swept and took out, tapped into demand and took out a high. And then three, these are weak points in the market. We also have what in this area to target, guys? It's all lining up. It's all lining up. We also have relatively equal highs right here. These 2 points. They are not equal, but they are relatively equal. So this high and this high is basically a double top. So in this example of liquidity, we have Asia highs intact. That is liquidity in the market. We also have a double top in the market. We also have two weak, very weak highs, right? Two very weak highs. And then we also have a level of demand, which we're not talking about here, that we're tagging into, and we're pro trend. So this is how you would use liquidity to propel your trade in for the future, right? Let's go find more action. In this range, all you want to do is find your low and your high. This is very, very simple. Find your low. Find your high. Okay, cool. In between this range, where who's in control? Bulls are in control. Why? Because this level of supply right here could not do what? Its job is to take out this low all the way down here, but it couldn't do that, right? So we know that in this area we have a fair value, something like that, buy to sell wicks, whatever it is. We could go over that another day. and we're looking to buy. So now that we're looking to buy, we also have a target. Where's our liquidity? Well, this swept liquidity. So this low is protected. Very simple. This low is protected because we swept liquidity. But this high took out these lows, but these are weak lows. Even though they made new high, our range is high to low. So this high job is take out the low. This low's job is right here was to take out these highs, which we did. Hence why it is a respected level. So when we're looking for our liquidity in the market, we see that this level took Asia highs, took the lows. Now we tapping into some sort of demand. If you want to take a trade or you're looking to take a trade or looking for focus, you can say, okay, I want this high minimum. That is my low hanging fruit because we are in the demand low. We are in the discount, which we'll talk about in another video. We are in the discount of this level, and this is a weak point in the market. It is a very weak high, right? Now, you might ask yourself, why did this happen? Well, just go back and validate price. If we talk about Asia session again, Asia high and lows, this right here took Asia lows and then went immediately for these Asia lows, right? Simple, very, very simple. It had to tap into something to the left, right? Exactly what it did. It tapped into something to the left and then went and took this liquidity out. So this may look like a strong move, but one can anticipate this move potentially more so like something like this. Take the highs, didn't take the lows, but this was just a strong news outlet that came in and actually just took out all Asia session lows and everything like that. Very, very simple concept. We come over here, we're in supply, we tag Asia, we tap into supply to the left, and we take an entry to take out the lows. We also have Asia lows here to target if we zoom in on all of this, right? So for example, we had a supply level here. The supply level took a low. It actually had another level over here. So we got a supply chain going. We moving down this chain. This level here, we want to take a trade from, but we wait for time. We come up here, we sweep Asia highs, and then we take our entry, and then we target Asia low, weak low, because why this low is weak is liquidity. It's not an important low because it didn't do what? Take out this high to the right or to the left. It was supposed to do that, and then we could potentially do that, but it couldn't do that, so it is now weak. Hence why you see in the supply market, price moving down, right? Because these lows couldn't take out the highs. If you take out the highs, now we start switching over, right? So let's go over that really quick on the daily. So on the daily, if we look at GU and we say, okay, internal, external range liquidity, very simple. This, and this is how it happens. I'll show you on the daily in the 1 minute. So we have a high and we have a low. Very simple, right? A high and a low, which came from this point to this point. Now, in a higher high, higher low standpoint, we expect price to do this. But why this is the daily time frame. We don't know when this is going to happen or how it's going to happen. So the way that we do that is we zoom in down here in the first break of supply. So the first break, because we were already bearish. So once supply breaks, right? Once we get one of these market shifts on the lower time frame, we are now moving up all the way through this action, right? We are moving all the way up through this action, as you can see. So we break supply levels here, we play around, we come here, we come back. And then as you can see, we make our way all the way up and we tap into that extreme supply somewhere around here. Tap into the extreme supply. Now, it's two things that could have happened here. We could have reacted, came up here and continued, right? Or you can wait for the opposite to happen because it's the same thing. So once the first level of supply broke, which was this last level here, now we say we are bullish and we are going to the extreme of this point. Once the same thing over here, once we break the first level of demand or supply or structure right here, we look for an entry and we can say the same. We can enter all down the road here if we wanted to. It's a bunch of entries here, but we can enter here. We can enter here potentially. You could potentially enter here if you wanted to. And then price probably start getting a little overrun. But you can take both of these trades and say, I'm going to target these lows because I understand internal and external range liquidity. Now, does that mean you have to hold everything until this point? No. But This is how you trade internal, external range liquidity, because once that first level breaks, then you get another break and another break. Expect, especially if we are bearish pro trend, all we just did was make lower low, lower high, lower low. Very simple. It is that simple. That's all we did. So understand that is how you utilize liquidity in the markets. Now, on a daily basis, for our last segment, when we talking about old highs, old lows, and like just a daily bias of like what we want to trade. All right, so when we talking about like something like NAS and trying to figure out our daily bias or such, something like that, or where's the liquidity? Let's say we were here and we say, okay, I'm looking to buy. This didn't happen yet, right? I'm looking to buy. Where's my liquidity at in the markets? That's the first question you want to ask yourself. Well, I see that price took liquidity of these Asia lows, and then we took out a high. That is a protected level. So I know I can map that level out somewhere and say, all right, cool. I'm looking for that. Now, as far as once we get to that level, why would price go up? Why would price continue to the upside? Well, we would then have a weak high, right? Because it couldn't take out the low and it held. We would have a weak high. We will also we also have Asia highs rested here, liquidity. And see what else we got. We have demand zones that have been taken already internally. So now we come into the extreme of this level. So if I take this trade, is the liquidity below us? Well, we have this low, but it's protected, right? I don't really have any other liquidity lower at the moment before that I believe that we'll go grab before we grab this. So when you take this trade, you can say, hey, listen, stops there, stops there. You can simply target this high and this Asia high very confidently, knowing we have Asia low high still intact and we have a weak high. This is a weak high because it couldn't do its job of taking out this low and then starting a new trend. It couldn't do that, right? But what we did get was a protected high, making the lower high, and then we're going to make a higher high. And the same thing happens again and again and again. It's very, very simple how you use liquidity in these markets. Remember, again, all of this is very confusing, but all you have to do is go find it consistently, align it with your trading plan, and say, hey, where's my double tops, triple bottoms? Where can I target those? How does it align with Asia's session? And how can we figure out how we want to utilize this in the markets? Internal, external range for swing traders and for day traders. Actually, let me show you on the 1 minute really quick because this one is golden. I'm telling you now. Let's find our range. All right, cool. Because I was in these trades today. It's crazy. So let's find our range. This is our low, and this is our high. Simple. We took Asia highs, Asia lows already, so that's not what I'm targeting. But we potentially could reverse because I'm seeing some sort of reversal side. But we have double bottom down here. We also have, if we look internal into the range, we have a triple bottom down here, right? We have this trend line liquidity right here as well. And then this will be potentially an old low. Now, this could be a strong low because it took out this high, but this high was liquidity. So actually, this is not a true high, but that's a whole nother conversation. So potentially, if we go bearish, we are coming down here to take this out, and we got reason to come lower. Now, also, we have liquidity on the upside right here. We have relatively equal highs up here, but that's a little bit far. We probably would have went and got it right here. We couldn't make our way up there, right? So where's our liquidity now? Oh, this internal. But how will we know on the 1 minute when price is going to go down there? Well, we do what? Our first level of what? Demand, break of structure. Cool. Once we get that first break, we come back and we look for our entry. Entry here, all right? Stops up here. Or if you want, stops closer, but here, boom. You can target this low knowing, hey, we should be taking out external range liquidity. We also have another reason to go lower, double bottom. It might take us a little longer to get there, but we'll get there because that is key liquidity in the market. But our low-hanging fruit target right here, because easy, triple bottom right there. Very, very simple. All right. Also, once that first level broke, it gave us a couple entries. It gave us one entry. It gave us a number 2 entry. right here, stops right there. And even a number 3 entry in here, which I won't map out crazily, but that was a number 3 entry right there. And you target that internal range liquidity to take either, you don't always take out the external range. It might not take this low. It could come down here if we were bullish, respect this low, and then make a new high. But once that first level of demand or anything internally down here failed, we can expect price to fill in and target that internal range liquidity to make a new high or continue lower and make a new low. So that is how you use liquidity, and keep it very, very simple for you. You're gonna go back and have to watch this video, but I guaranteed you that you will know how to utilize it and how to see it in the market. Go on the charts and look at all of this, because you're going to see it all over the charts. It's going to be easy to break down. It's going to be easy to understand, and you guys will be great. So with that being said, I'm going to catch y'all. I'll see y'all.